things will get more expensive. The almost immediate impact is that with Trump being in power, with US assets looking attractive, dollar is going to be very strong. So your average consumables, luxury items, if you're into that, is likely to experience a bump up easily north of 10%.
Hi, I'm Andrea Heng and welcome to CNA's Money Talks podcast. So Donald Trump is US president for the second time. And the big headline staring us in the face is his plan to increase tariffs. Now, we don't know the details just yet, but here is what we could be looking at. As much as 20% increased tariffs on imports from all trading partners. That includes us. And it could also go up to as high as 60% on cargo from China. But how does it affect you, me, and our money collectively and individually? Let's ask Abel Lim. He's head of wealth management, advisory and strategy over at UOB. Welcome back, Abel. Good to have you.
Thank you very much for having me.
All right. So, Abel, here we are. The Donald is coming back. How will this second Trump presidency affect the money that's in our bank accounts, in our investment portfolios? Make that connection for us.
Okay, here's the thing. Very often we keep hearing about Trump 1.0, and it seems overly convenient for individuals to start thinking about Trump 1.0 being the same for Trump 2.0. Unfortunately, it is actually quite different. There are similarities. Trump is, of course, threatening, to your point, tariffs against some of the major trade partners, particularly those with huge current account imbalances. But at the same time, he's also talking about immigration policies. He's also talking about extension of personal tax relief and corporate tax cuts, and even regulatory reforms in the financial and the technology sector. So all this will have material impacts across the globe and also in Singapore.
Yeah.
Now, what's going to happen? If Trump gets his way, he's very likely to have a lot of say in terms of how the United States executes some of its foreign trade policies.
That's right.
So what is going to happen? Tariffs is actually not good. It's inflationary in nature. It makes the cost of imports higher, which means that, and what you've articulated, 25%, 60% from Chinese exporters, all this will add up to the cost of Chinese goods and external imports, which means that consumers in the United States will have to pay the additional percentages which is being applied.
Yep.
That introduces inflation. So therein lies an issue. That's point one. Now, the second point is that if he's successful in the immigration laws, removing all the illegal immigrants, you're going to see wage costs bumping up.
That's right.
That, again, is also inflationary in nature. So if you add these two together, I think we are going to see the Federal Reserve struggling to contain inflation.
But the higher interest also means healthier portfolios, especially if you're buying into things like bonds and treasury yields, right?
That's a very, very good point. So yes, yields will stay higher for longer from our current standpoint, which is an excellent opportunity for investors who have not locked in investment grade bond yields yet to get into the market right now. Because our projection is that inflation will continue to trend lower. When, we don't know. Because on the back of what Trump is threatening to do, the inflation question mark is getting bigger.
Yes.
But we do expect inflation to continue to trend lower, which also means that rates will continue to fall. This is a net positive for bond holders, especially when interest rates and bond prices has an inverse relationship.
That's right.
So this is a great opportunity for investors who have not gotten into fixed income, particularly investment grade bonds, high quality issuers, to participate in this market at this current juncture.
Okay. So you talked about how we tend to make this mistaken distinction between Trump 1.0 and Trump 2.0. There may be some similarities. There are a lot of key differences. So walk me through that. Financially, how different will it be if we compare Trump 1.0 to Trump 2.0? Let's get into the details of that.
Okay, the similarities first. It is going to be volatile.
Okay.
There will be impact on every country, every economy, and in investors' portfolio. But here's a very interesting point. Since 2017 to now, 2024, interestingly enough, whilst United States trade with China has fallen about 15%, US trade with the rest of the world has improved by 43%.
Right.
So that actually represents opportunities.
That's right.
So on one hand, and everyone's thinking that it's going to be a very volatile year, which I agree is going to be volatile. But if you stay the course and if you are nimble and if you are reactive enough, you actually can find gems in the industries. Take, for example, Trump's policy on deregulation. We think that it's very good for the financial system and also very good for the tech sector with its pro-growth stance.
Right.
So the industries in that space, the ecosystem, people that actually supports those industries are likely to benefit from this tailwind. So similarly, if you think about how Trump is likely to enforce tariffs on Chinese goods and a universal tariff across other countries, it's going to make you as consumer a lot more likely to consume US-made produce.
Right.
US-made produce.
Which is what he wants.
So that also translates to small and mid-cap stocks in the United States starting to look attractive, particularly when rates are actually trending off. So those are some of the opportunities that we have highlighted earlier on this current trend.
Right.
And these are some of the things that investors should not ignore, considering that these are some of the known facts which President Trump is likely to enforce in the near future.
What other differences are there that we should be looking out for that could be risky?
One of the first key difference is that the timing of the execution plan. Now, if you see Trump 1.0, he actually enacted his tax cuts and corporate rate relief as a first stance. I believe that lasted for the first 2 years of his term. Tariffs only kicked in probably about a year after.
Yeah, quite late, yeah.
Yeah, so it's about a year after, and that's when the tit for tat between China started to happen and it started to see.
And before you know it, it was the next election.
Yeah. During the tax cut period, markets actually rallied very well. And once a tariff started to come into force, markets started to react quite negatively. This time around, we think that he's likely to do both together.
Oh.
So we are not going to enjoy that nice rally before the correction.
Right.
I think we are more likely to see a negative market reaction quite early in the game, especially when he starts to go out there to start pushing some of this tariff initiatives that he has. However, we also think that he's probably going to use this tariff as a bargaining chip to go to certain countries to ask for concessions in terms of trades.
He is a keen negotiator.
He is a very good negotiator. So in the face of that, he's likely to use those to negotiate in Europe for better concession, maybe in Africa and maybe in Southeast Asia. A lot of people are just talking about the one side case about US companies.
Yep.
The truth is, Chinese companies have been actively relocating their manufacturing capabilities outside.
Yeah.
Because they are actually trying to change their portfolio construct. They're no longer just purely interested to become the factory of the world.
Yeah.
They've actually moved up the technological space, the higher manufacturing space, and they're actually letting a lot of the other countries with lower cost base to take on the low manufacturing sectors.
Yeah, and this is only good news for us, especially those in ASEAN. Companies stand to potentially gain a lot from these dynamic movements in between the two superpowers. But there's also a bit of a downside for us as well, isn't there, Abel? I'm talking about higher costs of products, of items, of basically everything that affects us when these tariffs, if and when, I should say, these tariffs come into force. So the thing is, how much more expensive will these things cost us?
Unfortunately, at this current juncture, it is quite hard for us to predict the absolute impact on what the tariffs and the inflationary stance is likely to impact Singaporean per se. What you can say for sure is that it's likely to come. Things will get more expensive. Take, for example, the almost immediate impact is that with Trump being in power, with US assets looking attractive, dollar is going to be very strong. So that makes US produce imports more costly.
Good thing I have a New Year's resolution to cut back on shopping then.
Maybe shop elsewhere.
Yeah, maybe shop elsewhere.
China is looking quite attractive right now because the Chinese yen is likely to have an opposite effect on when the dollar starts to strengthen.
Right.
Now, one of the key challenges on the back of a strong dollar, you're likely to see almost every import start to go up in prices, not on the raw material front, but also on the shipping front, because today shipping cost is going to go up and it's priced in US dollar.
Yes.
So everything adds up. So your average consumables, luxury items, if you're into that, is likely to experience a bump up easily north of 10%.
Wow. Okay, that's a number that we need to remember when we go shopping next time. What's going to be the most costly expenses or items emerging from this scenario? What else is the average Joe like me going to have to contend with in terms of higher prices?
The positive thing of this supply chain reallocation
Right.
is that it's meant to address potential cost hikes in this space. So what traditionally was manufactured in China, for example, it's now being manufactured, garments, for example, manufactured in Vietnam, Bangladesh,
Cambodia as well,
Cambodia as
yeah.
well. But inevitably, it really depends on how aggressive Trump gets to apply his policies. So whether they balance each other out is a big question mark. So potentially you could see very basic goods like your everyday wear, your clothes, your shoes, to experience an inflation.
I think from Singapore's perspective as well, because we import so much of our food, that's certainly going to go up as well, right?
Food-wise, the good news is that I think our Singaporean government has been actively trying to manage this import costs. If push comes to shove, I'm pretty sure the authorities will be looking at this actively to ensure that Singaporean cost doesn't get totally out of whack.
Yeah.
But then again, a lot really depends on what happens in the next 2 weeks when he comes to office and the next 100 days when he actually applies some of his campaign policies and promises.
So how do we then buffer individually? So you talked about how the authorities might look into helping us mitigate some of that impact, cushioning some of that impact. What can we as individual consumers do then to buffer or even cushion some of the impact? I'm not saying all because it's inevitable, as you said. What bright spots do you see for us here?
So on a portfolio standpoint, I've already kind of hinted on the first one, which is focusing on high quality investment grade bond issuance. Okay, this company continues to pay very attractive coupons, continue to clip those coupons. If you're in a fund, you reinvest them, you enjoy compounding. So all this helps you buffer some of these potential threats in itself. The old adage, diversifying your portfolio. This gives you the opportunity to not only mitigate downside risk, you also expose yourself to potential upsides because you are highly diversified. Your industries, or sectors, and even countries that actually can benefit from some of this potential policies, threat, so on and so forth. Like the financial sector, we think some of the deregulation will make more efficient use of the capital, especially when they are less regulated in the sense that they are allowed to use some of their capital to do more productive stuff.
That's right.
His pro-growth policies is actually very good for the technology sector. So some of these industries are likely to benefit from some of his policies. Last but not least, we think that gold is an attractive option. Gold has traditionally been a safe haven, especially when I mentioned volatility, uncertainty that continues to exist. And the conflicts around the world hasn't ended.
No.
So it continues to become a very attractive safe haven for investors to consider in the portfolio. And at the same time, it's also a great inflation hedge. So typically we think that gold will continue to shine very brightly, pardon the pun, and central governments around the world will continue to stock up, particularly to buffer up some of the currency weaknesses. So gold will continue to shine in 2025 going forward.
Indeed.
Last but not least, we actually think that Singapore, being one of the best run nation around Southeast Asia, great governance, great infrastructure, continues to attract a lot of it's a safe haven.
Yeah.
We were likely to see fund flows coming into Singapore given the uncertainties and volatilities that's already in the markets.
Yeah, it pays to be safe, I should say.
It does.
Abel, thanks for coming back on the podcast. This has been really informative and hopefully it'll calm some nerves as well. And with Trump 2.0 happening in 2025, we hope you understand better what it means for you and your money. If you've got any comments or questions, you can always leave us a message. You know the drill. Money Talks is available on Apple Podcasts, Spotify, and YouTube Music. Do leave us a rating while you're there, by the way. Credits to the team: Crispina Robert, Tiffany Ang, Junaini Johari, Joanne Chan, Hanida Amin, and Saya Wind. I'm Andrea Heng on CNA's Money Talks podcast. Goodbye.